Joining me now, we've got Thomas Martin, Globalt Investments, Senior Portfolio Manager. Your strategy right now is to maintain diversification. So walk us through how you're doing that.
Yeah, so we have exposure to really all aspects of the equity markets, both in the United States and abroad. But we're fairly neutral in terms of that exposure with regard to growth and value and large and small. Our biggest overweight really is in the mid-cap stocks and in mid-cap growth. And we are underweight in international companies, but we still have, some decent exposure there. We have a duration neutral in fixed income. And we have some, I guess one place where we're a little bit kind of more diversified or more conservative is to have a little bit of dry powder in cash that we can use going forward. And in the alternative space, we have a fairly large exposure to gold and the gold miners, which has been a good substitute for the equities as it's been about as strong as those markets have been.
And so all that in mind, coming into the start of this week, we were already 98% of the way through the S&P 500 earnings reports. And so as we essentially kind of close off this earnings season, what are the anticipations for how investors should position themselves, knowing that there are going to be some areas where there was no guidance or diminished guidance that they're going to have to kind of measure up against? Does that set us up for any type of relief in the next earnings season?
Well, I think what's interesting about the earnings is that for the first quarter, coming into the quarter, we were looking for about 7% growth, and exiting the quarter with the actual experience, it was about 13% growth. Now, in the meantime, the estimates have been lowered for the second, third, and fourth quarter, and so therefore for the full year. So growth expectations have come down a bit, notwithstanding the strong quarter. And there are a lot of cross currents in the market. Companies are not getting any credit for saying they don't know what's going to happen. And companies that are saying, we have some degree of confidence are getting credit for that. So our approach has always been an earnings-based approach and looking at what happens with their estimates. And so we want to focus on those companies that are able to work their way through it and de-emphasize the companies that are having more struggles.
And so according to data from FactSet, Magnificent Seven companies reported earnings growth above 25% for the first quarter. So for the other 493, what do those opportunities look like, especially as it relates to maintaining their earnings growth or trying to solidify confidence among investors? And where are those opportunities from your perspective?
Yeah, so you still have opportunities in the healthcare area, although the stocks certainly haven't reacted very well. But there's the earnings growth there is expected to be above 10%. And, we see opportunities in the communication services sector. So there are a number of companies there that are in the more entertainment type economy, the experiences economy, and we want to be focused on those names. Those companies are reporting pretty well. Consumer names that are also in the experiences area are faring well, and so we want to have some exposure there. Also, in the industrials area, the AI trade, the electrification trade, those are companies that are continuing to see, good prospects, not just now, but for quite a while into the future.
Just lastly, while we have you here, you in your notes to us said that the Fed is in extended skip mode, despite the president tweeting out, or I should say, truthing out. He posted on social that he wants, of course, as he's continued to say in the past, for the Fed to cut rates. The likelihood of that, and walk us through your Fed in extended skip mode.
Yeah, of course, President Trump has always wanted rates to be lower, so that's not really a surprise. And it's kind of counter to what we saw in the data today, which was a stronger economy and a quite resilient labor market. So, the expectations for the Fed actually to cut were increased because the data right before this was more stagflationary potential. And so you got a rising in the expectation for a cut in September and then a second one in December. That's backed off a tiny bit, but not very much. The Fed just continues to say they want to be patient, they want to be measured, they want to be careful. And I think that, looking for a cut in September just to have a cut, doesn't really stack up with that kind of a philosophy. So our view is that there's a pretty high bar for a cut. I mean, certainly they don't want us to go into a recession. And if we get some data that is definitely pointing in that direction, we think the Fed will take action. But we just don't see that happening. Yes, there's a lot of uncertainty with regard to what will happen with the tariffs, but that's exactly it. It's uncertain. We don't know what these negotiations are going to produce. Could have no tariffs, could have 10% tariffs, could have higher than that. And so when we get that information, the companies will react and consumers will react, and we'll see what the Fed does when they get some actual real data.
Thomas, good to see you. Thanks so much, as always, for the insights.
Great. Thanks so much.